Today, never fear, the politicians are here. Hello, it's Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 6th of April 2019, the latest digest of finance and property news with a distinctively Australian flavour. And this week we had the budget, an RBA statement, and over in the US, Trump was urging the Fed to cut rates. And if you look carefully, you can see, therefore, quite a lot of political interference in the middle of the economic data. Just before we get started, just a quick reminder, if you find our posts helpful and useful, you can contribute to our work by making a contribution via Patreon, here's the link, or a one-off donation via PayPal. We really appreciate all those who are helping us to continue to make great content. So let's get started with the latest review of the news. And I think a good place to start is with the Reserve Bank statement issued on Tuesday when they left the cash rate where it was. And while superficially the statement really didn't add much to the debate, and it's pretty much the same old, with wages growth effectively expected to rise later thanks to the fact that unemployment remains low. But they did again make warnings about the housing sector and household finances. However, if you read the end of the statement carefully, it seems to me that they've now left the door more open to potentially cutting rates, which is something that I think the Reserve Bank was trying to avoid doing, but which now many commentators are suggesting will indeed happen ahead. Now, one of the little tidbits worth watching is what's happening to the BBSW rates, and in fact they have come right back to pretty much where they were about a year ago. And this, superficially at least, suggests to me that there is more room now for banks to potentially cut their rates a little. However, don't be so sure, because according to the latest stats in the RBA charts, bank margins are still under pressure. And if indeed interest rates are taken lower, that means that bank margins will still be in difficulty. So I'm not expecting any significant rate cuts for mortgage holders ahead anytime soon. Now, just touching on the budget, and by the way, there is a separate post where we went into considerable detail with regard to the policies announced. It's worth noting the plan to try and eliminate net debt down the track. But of course, there is a long way to go to achieve that, and their announcement of a surplus next year in cash flow terms is of course subject to a whole bunch of different factors. And let's face it, the real reason why that's possible is because the iron ore price is much higher than people expected thanks to problems in Brazil, and therefore we're selling more to China. And also there are some other accounting trickeries and also some slowing of spending on the NDIS thanks to lower than expected demand. So these numbers, to my mind, are not particularly positive, and of course there is an expectation that wages growth will bounce back quite soon. Now I just want to focus on that for a second, because this chart shows the projections in previous budgets relating to where wages growth was likely to go and what actually happened, and frankly it's a pretty appalling record. They consistently overestimate wages growth, and then the true numbers are consistently much lower. Now, we can debate all day whether that's because their initial estimates are just way too optimistic or whether other factors came in over the top. But to my mind, I think we have a structural issue with regard to wages. And in fact, if you look at income per capita, there's really been no change for 5 or 6 years in real terms. So I don't believe the wages projections in the budget, and therefore I don't necessarily think that those future expectations of repaying the debt are really that real. And if you want more evidence of that, it's worth looking at Westpac's analysis of the net new spending, which essentially shows that next year it's a really small proportion of GDP, and even further out, it doesn't improve very much until way out in 22-23. And just to give you a relative comparison of all the handouts proposed compared with what was done after the GFC, it's about 1/9 of the total stimulation that was offered back then. And so my view is that the small amounts being offered to households in the next year or two will have very little impact on total incomes and therefore total economic performance. This budget was frankly a political budget more than anything else. And it's worth noting that the budget's called out some of the risks relating to our trading partners. Of course, Australia is highly dependent on our exports. Indeed, around 30% go direct to China, and a lot of those relate to things like iron ore. So if our trading partners get into difficulty, that could trigger a further set of questions and issues locally. So let's now turn to the housing market. And CoreLogic released their latest statistics, which showed that across Australia, dwellings have now slipped by more than 10% across Australia in the upper quartile, that the capital cities are more than 11% down, and even the regional areas are sliding around 3.9%. Now, it does vary by different locations, with Canberra still a little ahead, Hobart still ahead, and Adelaide slightly ahead. But in the major centres, Melbourne is down now 13.9% in the upper quartile over the last year, and Sydney is down 11.9% again in the upper quartile over the last 12 months. And that's a really important point to make a note of, that essentially we continue to see the top end of the market being more hit than the bottom end with price reductions. But we're also seeing price falls spreading more broadly across the market, and we expect that to continue. And the auction clearance rates continue to grind on. Some are arguing that there is now considerable evidence to show that things are on the mend. And it's true that the clearance rate in Sydney was at 54%, Melbourne 52%, and the weighted average was 50.9%. But it's worth remembering that the total volumes going through the system are considerably lower than a year ago, around 13% lower now. And there are still a number of auctions that are unreported, which means that the clearance statistics are probably considerably overstated. So I still maintain that there is very little evidence here to suggest that the market has turned a corner, and I still expect more home price falls ahead. Now, we reported our latest mortgage stress data to March 2019, which of course is based on our household surveys. And once again, we see the rise in mortgage stress continuing at 31.6%. That's the highest it's been ever. And on this chart, we show the standard things like mortgage rates, the cash rate, and where wages growth is. But the critical point, which came from the Reserve Bank this week, was that the debt-to-income ratio has now risen again to 189.6. And that really is the core issue. We have households who are highly indebted, and we have more than 1 million households who are now struggling with mortgage stress, meaning they have a cash flow issue. So our mortgage stress work got coverage on the ABC under the headline, "We've never had it as bad as it is." And of course, they made a link with the potential upcoming election, that many households are caught in a worsening national housing crisis. And our research was also presented on the radio on ABC PM. Again, more evidence emerging that the national housing crisis is worsening. And it's worth recalling the latest chart pack data from the Reserve Bank, which shows again that household consumption continues to grind lower, as the saving ratio is also relatively low, and the disposable income of households continue to shrink. And that's another reason why the households in our surveys are reporting more mortgage stress. This is a very significant issue for a significant number of households now, and not just those at the bottom of the market. Now, on the DFA blog, I have just posted a legal opinion relating to the question of bail-in of deposits in Australia. As you may know, this is something that we have been working on for quite some time, John Adams and myself in particular, as well as the CEC and a number of other organisations. And this particular opinion looks at the question of whether, in theory, it is feasible for deposits to be bailed in Australia. Now, you can watch our video on this over on In the Interests of the People, and there John Adams and I go through this in some detail. But the key takeaway is that our assumption that the terms and conditions within deposit accounts in the banks does leave the door open for deposit bail-in is proved to be correct. And therefore, all of those letters from Treasury and from various members of Parliament who try and deflect a discussion of deposit bail-in into a discussion around deposit insurance is actually misplaced. You can read all about this on the DFA blog, or indeed watch that post over on In the Interests of the People. Now, I'm going to report the DFA Household Financial Confidence Index in more detail next week, but I thought I'd give you just a quick preview today, seeing as I've done the charts already. And the news is that the Household Confidence Index has fallen again to 86.1% at the end of March, and that's pretty much as low as it's ever been. And what's interesting about the distribution of stress and indeed levels of confidence is that pretty much all types of households are feeling it. And our chart shows that more recently, it's those who are renting who have got a little improvement in confidence from a low level, but those who are mortgaged are feeling it quite badly now. Not surprising given home price falls. And even those without a mortgage, owning their property for free, we call those the free affluents, they are below the long-term average and they continue to dive. And my point here is that many of those particular households are more likely to support the Conservative side of politics. So even the home territory of the incumbent government at the moment is questioning financial confidence, and in a way is questioning the government's ability to manage the economy. I think that could be quite significant ahead. And we'll cover this in more detail next week. And so to the markets. The S&P ASX 100 closed 0.86% down on Friday at 5,090. And the ASX 200 financials closed down 0.92% on Friday to end at 5,829. The Australian Volatility Index, or VIX, or sometimes called the Fear Index, was up 2.16% on Friday to end at 1178. Looking at individual banks, the ANZ Banking Group was down 1.18% on Friday to end at 25.95. The CBA was down 0.48% to end at 70.89. National Australia Bank was down 1.43% to end at 24.81. And Westpac Banking Corporation was down 0.69% to end at 26.05. Amongst the regionals, the Bank of Queensland was up 0.21% to 9.49. They're going to announce some results quite soon. And Bendigo and Adelaide Bank was up 0.41% to 9.90. Suncorp was down 2.43% to 13.24, and Macquarie Group was down 0.80% to 130.7. AMP was down 2.25% to 217. Genworth Mortgage Insurance was flat at 240. McGrath, the real estate guys, was up 4% at 26 cents. And Yellow Brick Road Holdings was flat at 6.8 cents. Mortgage Choice, the mortgage aggregator, was flat at 92 cents. And the Aussie dollar, US dollar, ended down 0.05% to 71.08. Looking at the cross between spot gold and the Australian dollar, it was up 0.05% on Friday to 1,817, and the Bitcoin Aussie dollar cross was up 0.09% to 5,015. And over to the US. US stocks rose on Friday, boosted by better than expected job growth in March, and that eased concerns of an economic slowdown that have periodically roiled financial markets over the past year. With Friday's gains, the benchmark S&P 500 has closed higher for 7 trading days in a row, its longest winging streak since October 2017. The Labour Department said that non-farm payrolls rose by 196,000 jobs in March, topping the 180,000 new jobs forecast by economists. Data for February was revised upward to a gain of 33,000 jobs instead of the previously reported 20,000, which was the smallest gain since September 2017. The data provided reassurance 2 weeks after the yield curve between the 3-month Treasury bills and the 10-year notes briefly inverted, in what is commonly viewed as a sign of an ongoing recession. However, wage increases slowed in March, leaving the data broadly supportive of the Federal Reserve's decision to suspend its 3-year campaign to tighten monetary policy. A dovish Fed, along with hopes for a US-China trade agreement, lifted the S&P 500 to its highest level since October the 9th, putting the index only 1.3% below its record closing high. Stocks across the world also got a lift from President Donald Trump's comments on Thursday that Beijing and Washington were close to a trade deal that could be announced within 4 weeks. Trump later said he would not predict the deal would be reached. And next week, corporate earnings will come into greater focus, with major US banks scheduled to report quarterly results. Analysts expect earnings for the S&P 500 companies to fall year over year for the first time since 2016. The Dow Jones Industrial Average was up 0.15% to 26,424. The S&P 100 was up 0.33% to 1,275. And the S&P 500 Financials was up 0.49% to 441. Goldman Sachs was up 0.07% to 202.38, and the Volatility Index in the US was down 5.6% to 1282. The Nasdaq Composite was up 0.59% to 7,938, and Alphabet Google was down 0.66% to 1,211. Amazon was up 1.01% to 1,837. Apple was up 0.67% to 197. Facebook was down 0.17% to 175.72. And Intel was down 0.57% to 55.60. The United States 10-year bond was flat at 2.499, and the United States 3-month bond was 2.43, down 0.18%, so the yield curve inversion has effectively come back to normal. Gold futures rose 0.12% to 1,295. Silver was down 0.06% to 1507. Copper was down 0.72% to 288. And oil futures was up 1.88% to 63.27. The Bitcoin US dollar was up 1.86% to 5,046 on Friday. This week will be remembered by the crypto market participants as something of a revival, because the total capitalization of all cryptocurrencies increased from April the 2nd by 18%, reaching $174 billion. The Bitcoin price spiked from levels just above 4,200 to 5,300. And daily Bitcoin trading volumes reached a record $23 billion on April the 4th. Such substantial trading volumes of the benchmark cryptocurrency were reached only in early January 2018, when the first phase of the large-scale crypto market correction took place. Now, of course, there's a lot of debate about what's driven that particular rally. Now, at the moment, it's not totally clear why there was such a strong rally, but it looks as though around 20,000 bitcoins were purchased via 3 large exchanges, and that caused the automatic activation of a large number of buy orders, plus a wave of stop orders for $500 million in short positions. But the lack of fundamental growth factors and some potentially positive news in the background may create some confusion amongst market participants. Indeed, I've read a number who are claiming that this is now the start of the next Bitcoin rally. I have to say, I think that's extremely premature, and you must remember that my perspective is that Bitcoin is fundamentally completely speculative. There is little to know what the true value is. The US dollar index was up 0.06% to 97.36. The British pound US dollar was down 0.30% to 1.3038, perhaps reflecting the ongoing uncertainties around Brexit. And the euro US dollar was up 0.08% to 1.1229. Deutsche Bank was down 1.07% to 7.57, and the Chinese yuan US dollar was down 0.02% to 0.1488. The FTSE 100 was up 0.61% to 7,446, and the FTSE 350 Financial Services Index was up 0.57% to 689.79, and the Royal Bank of Scotland was down 0.94% to 251.70. So overall then, another bumpy week, and I still go back to this point that there's a lot of political chatter overlaying the various economic data. And the fact of the matter is that jaw is not necessarily the same as taking true positive economic steps to address fundamental issues like debt and deficit and those sorts of things. It seems to me that we're in this phony war at the moment with lots of talk and no action. And I rather suspect in Australia the upcoming election will be more of the same old, same old. And finally, just a quick reminder, our next Q&A session will be on the 16th of April at 8 p.m. Sydney time. Here is a link to the show, and you can send questions ahead of time via the DFA blog, and a link is there below if you'd like to do that. I look forward to seeing you on the 16th. If you found this useful today, please share the post, like the post, add a comment or question. I read them all. And if you haven't yet subscribed, please do so to receive alerts by ringing the subscribe bell. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.